Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. In this video, we're going to cover 3 concept checks specifically on number 1, the early retirement drop, number 2, measuring your effective tax rate, and number 3, conversion impact on investment income, to make sure that you are on track with your 2026 Roth IRA conversion planning. So concept check number 1, do you understand how to project income during the early retirement drop? Let's take a look at our 2026 Roth conversion flowchart to make sure we understand which component of the process we are discussing. All right, so we're over here in the 2026 conversion flowchart. And in the last video, we had been talking about step number 4 here, which was entering your estimated or actual 2025 taxable income. Now, I know that everybody is at different stages with this particular step because for some people, your 2025 taxable income is not yet complete. However, as soon as you get your 2025 tax return filed, you should be able to wrap up step 4 right here within the personal tax planning template, and then you can give your full attention to step number 5, which is projecting your taxable income from the current year through the RMD starting age. Now, during this time period where you are projecting income from the current year out to RMD starting age, many people will encounter 2 basic components of the time period. One will be pre-retirement over here, and the other one will be the early retirement drop. And it's this component of the time period right here that we are going to be talking about specifically in this concept check number 1 for this video. So going back over here and taking a look at our overall Roth IRA conversion strategy chart, recall that the general pattern that we expect to see for most people is that during the employment years, your income level is going to rise as represented by these gray bars right here. And then once you enter retirement, you're going to experience what I'm referring to as the early retirement drop. And this is the point in time where you are post-employment, but you are also likely pre-Social Security, pre-pension, and pre-RMD. And in this early retirement drop, we can see that folks will often have significantly less taxable income for a period of time that averages anywhere from 3 to 5, maybe even 6 years. And this is the time period when folks tend to have the most room available in their brackets as compared to any other time, whether it be back in the employment years or whether it be further into the retirement years when Social Security, pensions, and ultimately RMDs start to kick in. So what I'd like you to recognize, if we compare the overall strategy chart, which is up here, to our 2026 Roth conversion timeline, which is down here, we are talking about the same early retirement drop, both in this section right here as well as this section down here. This is where the early retirement drop is located in the planning process that we're going through for Roth conversions for 2026. This is what the early retirement drop looks like from an income perspective if we're laying it out graphically. So the process of projecting income during the early retirement drop has 3 basic parts associated with it. Number 1, we have to consider what income will cease once we enter the early retirement drop, and the income could cease because of retirement itself, like you stop collecting your W-2 wages, or it could occur from changes to other things like your investment strategies, which were caused by the fact that you retired. So we have to consider how the early retirement drop will affect our income both directly and indirectly, so to speak. Then item number 2, we have to consider what income will stay the same. For example, income that is generated independent of your employment or retirement status. And that could be like rental income, it could be certain types of business income if they're passive in nature. It could be income that comes from an inherited IRA. It could be a variety of things that are not directly related to you being employed or retired. And whatever those things are, we have to project what the amounts will be during the early retirement drop. And then finally, number 3, we have to consider what income will not start yet. For example, it could not start due to the nature of the income or pension program terms themselves, or it could occur just by your ability to actively delay such income. For example, if we're talking about Social Security, which is basically just a government annuity, or if we're talking about pension programs that come from your former employer, you have with Social Security, and generally people often have with pensions, a fair amount of discretion regarding when exactly those programs are going to begin. And so if you employ your ability to actively delay such income, not only does it increase the amount of income you will collect when it ultimately starts, as is the case with Social Security, but it may open up a lot of room in those early retirement drop brackets, which is the perfect opportunity for us to get a fair amount of Roth IRA conversion done before these programs kick in and before RMDs start. So if we come down here and take a look at the personal tax planning template, think about those gray bars that we saw above in the overall Roth conversion strategy chart, and let's take that graphical representation and turn it into numbers. So as you can see right here, this would be the employment years where people are generating W-2 income. Maybe one spouse retires earlier than the other, but then at some point we're going to enter the early retirement drop. And that's where we will see W-2 wages taper off. We will see down here that perhaps Social Security starts for one spouse, but maybe not the other. Maybe pensions just start to kick in toward the end of the early retirement drop period. We do have to consider certain types of income that may continue during the early retirement drop and have nothing to do with employment or retirement status. But if you just think about how those gray bars look compared to the volume of numbers that you're seeing in this section right here, you can see that income in this period of time is substantially lower, and therefore this represents the room in the brackets that we are looking for, because this is where we are going to put our Roth IRA conversion income. By the way, check out this review that I just got the other day. It says, prior to using the personal tax planning template, I had been headed down the right path with what I was doing, but the personal tax planning template showed me how to save an additional $60,000 in taxes over the next 10 years. At which point I will no longer be paying any federal income tax. Now, this particular individual was one of the first people who joined the program, and he is following the strategy that we have talked about numerous times before, where he is attempting to convert everything that he has on a pre-tax basis into Roth. And thus, when he arrives at RMD age, he's not going to actually have any RMDs because all of the money will have been converted in advance. Thus, his only income will be Social Security at that point, and that means the Social Security will be taxed at 0% because there is no other income once the conversions are done. This is an amazing strategy right here, which will not necessarily work for everyone, but if you lay out your numbers in the personal tax planning template, you could certainly see if it would work for you and your family. And if it does, just imagine that, having all of your cash coming out of Roth as you need it for personal living expenses, plus all of your Social Security coming to you tax-free because there is no other income causing it to be taxed. Well, it's certainly an amazing outcome and an amazing strategy that you can use the personal tax planning template to lay out your numbers and see if such a strategy will work for you and your family. Remember that when you join my personal tax planning template program, you are quite literally standing on the shoulders of giants. We're closing in on 10,000 members who have worked through all of the iterations of the personal tax planning template since it launched in 2023. These folks have vetted the program, they've provided feedback, and they have helped me build out what is quite easily the best individual income tax training program on the market in the United States today. And most importantly, they have helped themselves to save their families 5 to 6 figures in unnecessary income taxes by simply number 1, laying out their numbers, number 2, finding room in their brackets, and number 3, proactively smoothing out their income through strategic Roth IRA conversion planning. Okay, now moving to concept check number 2. Do you understand how Roth IRA conversions impact your lifetime effective tax rate? Which, by the way, I may abbreviate going forward as LETR. But in fact, let's back up for a moment. How do you calculate your effective tax rate in the first place? Well, what I want you to do is think back to our discussion that we've had on MAGI. What did I tell you about the calculation of MAGI? I said that MAGI can be calculated in any number of different ways, just depending on what you're calculating it for. And the same concept is true with respect to effective tax rate. For example, let's say that your tax for the year is $68,741. And my question to you is, what is your effective tax rate? Well, the question you should be asking right now in response to that is, as a measure of what? As a measure of AGI? As a measure of taxable income? Are we talking about income tax taken as a whole? Or are we trying to determine our effective tax rate on specific components of our taxable income? The point is that there are many different ways in which we could calculate an effective tax rate. It could be based on certain portions of our tax. It could be based on our tax taken as a whole. It could be determined as a measure of AGI. It could be determined as a measure of taxable income. So to dig into this idea a little bit more, let's put on the old thinking caps with some examples. Assume we have two people with the following tax, AGI, and ETR information. Right over here, we have person 1. They are reporting $68,741 of tax for the year. They have AGI of $379,248, and their effective tax rate based on that measure of AGI is 18.13%. Now, we also have person 2 right over here. They have the identical amount of tax, $68,741, but their AGI for the year is $426,736, resulting in them having an effective tax rate based on a measure of AGI of 16.11%. Okay, now based solely on the information presented here, what is the most likely difference between the tax situations for these two individuals? Well, it would be likely that one of them is itemizing deductions and the other one is not, right? Okay, wait a minute. Now, how did we come to that conclusion? Well, where is AGI measured with respect to the total tax calculation? And the answer is that AGI is the line, quote unquote, that separates above the line items from below the line items. And so looking right over here at the personal tax planning template, this is the line, so to speak. Anything up here is going to be above the line, and anything down here is going to be below the line. And the question now is, what comes below the line? And the answer is 3 basic things, either the standard or itemized deductions, the QBI deduction, and now starting for 2025 and going through at least 2028, the OBA deductions. And so with the knowledge that the OBA deductions weren't applicable to 2024, which was the year we were looking at in the above example, and also the fact that the QBI deduction is generally not that applicable to many people unless you're in business or self-employed. And so therefore, for these two people to have identical tax on substantially different AGI, the most likely conclusion is that person 2 is itemizing deductions, whereas person 1 is not. Or said slightly differently, person 2 must have a number of these items that are below the line in order for them to have significantly more AGI but an identical amount of tax. Let's look at another example. Here we have person 3 and person 4. They both have identical taxable income of $350,048, yet one of them has an ETR that is about 200 basis points lower than the other due to a lower tax liability. So again, right here is person 3, they have $350,048, and person 4 also has $350,048 in taxable income, but the tax reported by person 3 is $68,741, whereas the tax reported by person 4 is $61,560. Okay, now again, based only on the information provided, what is the most obvious reason why something like this might occur? And the answer is differences in the character of income. In this particular example, person 4 has a higher proportion of capital gain income versus ordinary income as compared to person 3. So if we look down here at the character analysis of the income, person 4 has less income being taxed at the 22% marginal ordinary rate and more income being taxed at the preferential 15% rate on capital gain and qualified dividends, whereas person 3 over here has exactly the opposite situation. And so that is an example of how two people can have identical taxable income, but meaningfully different effective tax rates. It has to do with the character of income this time. Okay, now I want to show you something that just happened with one of your fellow members inside of the personal tax planning template program. So last year in 2025, this individual worked really hard to develop a complete understanding of the Roth conversion planning process. They laid out all of their numbers in the personal tax planning template. They honed and optimized their conversion strategy. They filled up their 24% bracket right to the brim. They did a perfect job of getting their 2025 conversion planned out, and then they got to their 2025 tax return just in the last week or so. They filled out all of their tax return information. And do you know what those absolute monsters over at TurboTax told them? TurboTax told them that they were in the 32% marginal tax bracket for 2025. I was absolutely livid when I heard about this completely erroneous information provided to this person by TurboTax. I was in fact so livid that these over here are actual photos of me getting ready to go have a little chat with TurboTax on this particular issue. Okay, let's break it down. Here are the relevant summary lines from the personal tax planning template for this individual. Right here, total taxable income, $447,346. Going down here to the ordinary income tax calculation, you can see that they are being taxed in the 10%, in the 12%, in the 22%, and in the 24% bracket under the current tax law. You can see right here that at the 15% preferential tax rate, they are getting $10,282 of long-term capital gain tax. And you can see right here that the grand total of all the ordinary income tax plus the long-term capital gain tax is $86,888. Now, here is the summary provided by TurboTax within their actual tax return. Right here, taxable income $447,346. It agrees to the personal tax planning template down to the dollar, as it always does. Right here is their tax calculated $86,888. That also agrees to the personal tax planning template down to the dollar, as it should. Now let's go through these lines over here one more time. Is this person getting taxed in the 32% bracket anywhere in this picture? No, they are not. Is this long-term capital gain item right here subject to tax at the 32% rate? No, it is not. It is subject to tax at the 15% rate. What is this item right here? It is the amount of net investment income tax on investment income at 3.8%. What is this item right here? It is the additional Medicare tax assessed on Medicare wages over a certain amount. This item is only 0.9%. What is this item right here? Tax credits. Are any of these items taxed at the 32% marginal rate? And the answer is 100% absolutely not. And yet right here in this tax bracket percentage provided by TurboTax, they told this individual that they were in the 32% bracket. This individual was absolutely livid. They didn't want to be in the 32% bracket. They were only trying to do their conversion into the 24% bracket. And of course, I was equally livid. You can see how I was dressed right here. I even blew up 5 buildings before I found the answer. And the answer is this little double asterisk insanity listed right at the bottom here. The tax bracket percentage right here is based on taxable income. So all that TurboTax did was to take taxable income of $447,346 without accounting for the fact that some of this, actually a decent portion of it, was capital gain subject to the 15% rate, and it just compared the raw number to the brackets. It said 447,346 must fall just right in here, and therefore you must be in the 32% bracket. That is completely erroneous. Of this person's total taxable income of 447,346, only 378,802 was ordinary taxable income subject to the ordinary income tax rates. Therefore, this person is only in the 24% marginal bracket. All of this long-term capital gain income is subject to the 15% bracket. There is no mathematics in the world except perhaps inside the TurboTax system, where you take income which is taxed at a maximum of 24%, and then you take income which is taxed at 15%, and somehow you put that together and say the total is taxed at 32%. Okay, not a single dollar of this person's income was ever taxed at 32% in 2025. Yet TurboTax reported a marginal tax bracket to their customer of 32% for 2025, which is not only lazy but completely erroneous. In fact, you know what it really is? It's the bull stuff. You ever heard of that? That's the stuff that comes straight out of the bull. Okay, that is exactly what that 32% number is. It's the bull stuff. And TurboTax should be ashamed of providing erroneous information like this to their customers. However, with that said, it makes a great learning experience for us. Because as I've said many times on the channel, when it comes to taxes, there are so many moving parts that you really just have to understand what you're looking at. You have to have a way to lay out your numbers in an organized and vetted way so that you can put all of the moving parts together. And that's where the personal tax planning template program comes into play, because you're never going to figure it all out in your mind. There are just far too many moving parts in the process. With the personal tax planning template, you can determine your lifetime ETR under as many different tax planning scenarios as you desire in order to determine the most effective strategy for yourself and your family. And what you will find is that even small changes in your ETR over the course of your life can add up to 5 or even 6 figures in savings for both income tax purposes as well as IRMAA purposes. If you look down here at this lifetime effective tax rate planning snapshot from the personal tax planning template, you can see that in this particular base case versus planning case scenario that was laid out over the lifetime of this individual, the effective tax rate for the person only went down by 1.4%. And the amount of IRMAA savings only went down by 0.2%. It doesn't sound like that much when you're looking at the percentages. But when you get down here and look at the numbers, a drop of 1.4% in ETR for this individual was about $80,000 in tax savings, plus another $15,000 in IRMAA savings over the time period in which this was measured. The opportunity for significant permanent tax savings over your retirement years is right in front of you. All you have to do is lay out the numbers, follow the program, and figure out what is best for your family. Okay, let's go to concept check number 3. Do you understand how Roth IRA conversions impact the tax you pay on investment income? Specifically, we're talking about the net investment income tax. Let's do an example. Suppose you're a married filing joint couple and as of 12/31/2026, you have $250,000 of AGI from all sources year to date. Now, at this point in December, you're trying to decide if you want to do a $100,000 Roth IRA conversion in 2026, or if you want to wait to do the conversion until 2027. Okay, so based solely on the facts provided, what is the first question that comes to mind for you? And by the way, this should be an easy one because I used the word that we are looking for earlier in the video. And the answer I'm hoping you came up with is, what is the character of the $250,000 of income that we already have for 2026? The character of the income that already exists may impact your Roth conversion plan for the year. For example, let's say right here we have scenario number 1, and in that scenario we have $100,000 of investment income. This is going to be your interest, your dividends, your capital gains. And then we also have $150,000 of non-investment income. This could be anything from W-2 wages to pensions to IRA distributions to Roth conversions to RMDs. Any of those items are not considered investment income. And so in scenario 1, we have $100,000 plus $150 gets us our $250,000 of AGI. Now, alternatively, over here in scenario 2, let's say that we have $0 of investment income, and our entire $250,000 of AGI is made up exclusively of non-investment income. Okay, now based on the information that is shown right here in these two scenarios, what numbers are we looking at down here for the 3.8% net investment income tax? And I hope the answer that you came up with for both scenario 1 and scenario 2 is 0 so far. Why is it 0? Because net investment income tax does not kick in regardless of the amount of investment income that you have until your AGI exceeds $250,000 for married filing joint. Okay, now continuing the example, what is the net investment income tax cost of doing a $100,000 Roth IRA conversion in both of these scenarios? In other words, for scenario 1, we will still have our investment income of $100,000. We will have our non-investment income of $150,000. Then we will have our Roth conversion income of $100,000 for a grand total AGI of $350. In scenario 2, the first two items will be the same. We will have our $100,000 of Roth conversion income, and that is how we get to the $350 for scenario 2. So once again, when I scroll down, what is going to be the net investment income tax cost of this one? And what is going to be the net investment income tax cost of this one? And the answer I'm hoping you came up with is $3,800 of net investment income tax cost for scenario 1. And $0 of net investment income tax cost for scenario 2. Okay, now why is that? Is the Roth conversion income subject to the net investment income tax? And the answer to that is no. Roth conversion income is not considered investment income for income tax purposes. So what happened is that the Roth conversion income, or any income really for that matter, caused the investment income, which was already there, to become subject to the net investment income tax. Because as I mentioned a moment ago, the net investment income tax is partially based on your level of AGI. In the first round that we went through, this $100,000 of investment income was here, but AGI was only $250, and therefore net investment income tax was not applicable. However, when we threw the $100,000 of Roth conversion income into the picture, it wasn't this $100,000 that was subject to the net investment income tax. It was this $100,000 right here that was already there in the first place, that became subject to the net investment income tax because this number right here went over the $250,000 threshold. Of course, over here in scenario 2, it doesn't matter that the AGI went over the $250,000 threshold because of the fact that there's no investment income in the first place. And so you're never going to have net investment income tax unless you have some amount of investment income. Do you see how many moving parts there are in the tax planning process? Imagine now that instead of just scenario 1 versus scenario 2 above, this was really 2026 versus 2027, and you were trying to figure out when to complete the Roth conversion, like we mentioned earlier in the beginning of the problem. Well, what if, for example, this $100,000 of investment income was really like a one-off or non-recurring item? For example, if your financial advisor harvested a $100,000 long-term capital gain in 2026 for whatever reason, but wasn't necessarily expecting anything similar to that in 2027, then in such a situation, you'd basically be paying an extra $3,800 in the form of net investment income tax to complete a Roth conversion in December of 2026 that you could have just completed in January of 2027 and paid $0 of net investment income tax in this fact pattern. There are countless moving parts in the income tax planning process. But unless you lay out your numbers so you can find and optimize those tax savings opportunities, tens of thousands of dollars or more will likely slip through your fingers little by little throughout the course of your retirement and wind up in the hands of the government. And Uncle Sam's most favorite part about that is that in most cases, you will never even know. And why won't you know? Because it's far too complicated to ever figure out inside your head. And unfortunately, that's how many people try to do it. By the way, I have just uploaded a major March 2026 update into the members area for the Personal Tax Planning Template Program. Recall that as of the last update, we were working on the conversion section of the Roth Conversion Tax Strategy tab. Recall that we were working over here in this section with the traditional IRAs and getting our QCDs, getting our conversions, getting our RMDs all calculated. Well, in this update, I have worked on the other section of that particular tab. I've updated the cash flow analysis to determine how much money is ultimately ending up in the Roth accounts. I've worked on our Roth IRA tracker over here to compare our projections to our actual year-end balances. And then the major item, which I know a lot of people have been waiting for, is that now we have a Roth Conversion Tax Strategy tab number 2 and an IRA entry tab number 2, both of these for spouse number 2, so that all of the items in the Roth Conversion Tax Strategy as well as the IRA entry can be tracked by spouse as they are supposed to be, and both of these tabs right here for spouse 2 have been completely revised such that they are up to date and equivalent with these tabs right over here for spouse 1. In addition to that, there is a complete overhaul of the IRA entry tabs. Again, which I know a lot of people have been asking about, including the traditional IRA contribution deductibility section. No joke, my friends, we have just gone from this Pinto spreadsheet right here for the IRA entry to this Lambo version right over here. Now there is both a Roth Conversion Tax Strategy tab and an IR entry tab for each spouse, as I just mentioned moments ago, fully updated with 3 all-new instructional videos that walk you through the changes and how to incorporate the new functionality into your planning. It just keeps getting better and better with the Personal Tax Planning Template Program. Because as I said before, you are standing on the shoulders of giants. The thoughtfulness and thoroughness and passion of everyone who joined before you is all rolled up into an individual income tax planning training program that's been iterated and vetted continuously since its launch in 2023. My Personal Tax Planning Template Program is easily the most comprehensive and accessible individual income tax training program in America. And I don't say that lightly. I've worked hard to make it that program. You can join the Personal Tax Planning Template Training Program with lifetime access for a one-time access fee at the link in the description below this video on YouTube. And that's going to be it for today. Thanks everybody for watching, and I look forward to seeing you inside the program.